Hi, and welcome to FXDD TV. I'm your host Lauren, and with me today, Mr. Kenny Agostino, market expert and FXDD VP of Liquidity. So today we would like to discuss a topic that comes up every now and then and get your expert opinion on it, flash crash. Can you help us understand what currency flash crash is?
Sure. So essentially a flash crash is a unique moment in the foreign exchange markets where there's a tremendous lack of liquidity at a given moment. There's a huge spike, usually to the downside, very high volatility, completely illiquid markets that can happen for a variety of reasons. One of them is computer trading. With the advent of computer trading, algorithms and APIs, millions of dollars could be behind these types of trade programs that seek out liquidity that at a given moment is just not there. The other one could be very unique positioning, which we've seen most recently in yen and some higher interest rate products. I think was a result of a carry trade. The most recent, I think the best example of a position-related flash crash would be the SMB crisis. In the case of the SMB crisis, which took place about 3 years ago, we had an environment where the Swiss National Bank president was basically convincing the market that he was going to protect the Swiss against the euro at any cost, etc., and giving people almost what they thought was a free trade. So in this case, euro Swiss, which was a currency that was not highly traded, not that liquid, didn't move that much, everybody was long it, and all the forces kind of came together, and when the base fell out, they had nowhere to go, and that created that very famous flash crash. So that's a couple of examples of how that can happen.
Thank you for your insight. How often does it happen in the market?
It actually doesn't happen that often. There's probably been a case of maybe a half a dozen over the last decade or so. As volatile as they are and as much news as they get, it really doesn't happen as often as you might think. The one that we had happen last week to start the year most likely was a carry trade where people are long a higher interest rate pair, and when they do that, it's usually versus the yen. So just imagine a group of 1,000 traders making up the entire market, and for whatever reason at one time, almost all of them have the same position. And in this case, if it was a carry trade being long sterling versus yen, Aussie versus yen, Kiwi versus yen, Turkish lira versus yen, all these higher interest rate pairs, as the market starts to move against them, they all have to get out at the same time, and it creates this vacuum, and that's what we saw early in the year with this current flash crash. Another aspect of it that certainly helps to help the move go even lower than we saw, or that should be, is banks, the main provider of the liquidity. Once these circuit breakers kick in, they'll stop pricing. They're not obliged to quote anymore. They don't have to do it, and if there's no need for them, if they don't have, in this case, a reason to buy, they'll take that liquidity out, and the computer programs will just continually seek out liquidity until it's a flash crash, which is what we saw.
Are there any specific time zones where the crash is more likely to happen?
In theory, there shouldn't be. I mean, these things are completely unpredictable and are total outliers in our industry, but essentially, we see them more in the kind of early Asian market. So foreign exchange is a $5 trillion a day volume industry. It opens Sunday afternoon, it doesn't close till Friday. But there is a time period each day when New York is leaving right around our 5 o'clock hour and Asia is starting to enter the market. And there is a little bit of a gap of liquidity there. And certainly if it happens in that time zone, which we saw early in the year in the Japanese yen, it's completely vulnerable. I think on that day as well, there was a holiday in Tokyo, so that even took some more liquidity out of the market and made that even more aggressive, and we saw the results.
Can retail clients protect themselves from this type of market event, and how does FXDD help its customers in this situation?
The short answer is there's not a lot that they can do. These type of events, which I mentioned earlier, come basically once every 2 or 3 years, are complete outliers. It's almost like a storm that comes that no one has any idea it's coming. I think one of the things that they can do is certainly, and I know FXD does this, try to trade with stops. We certainly encourage our clients to try to manage their risk as best they can. Another thing would maybe be stay away from the more liquid pairs. Certain currency pairs that are affected by things other than the normal day-to-day fluctuations. So as an example, unstable governments or pairs that really aren't kind of mainstream. As a regulated entity, FXDD, I think, does a great job in that we offer negative account balance protection. Certainly that'll help, in the case of these events. But, they make big news because they're completely unpredictable. You don't know when they're going to come. And in many cases, they literally last minute. So it's one of those things that you hope don't happen. You hope clients are not on the wrong side of, but you certainly have to be aware that they're possible. And again, I think recommending clients to do their best to trade with stops is the best advice we can give.
Well, thank you, Kenny, for your valuable insight. And that concludes our episode for today. Thank you for being with us. If you have any questions, please don't hesitate to reach out to our customer support team. We're available for you 24 hours, 5 days a week. Thank you and see you soon.